Do you realize that the markets are at key levels right now? Well, there are many of these key levels for different markets which influence the equity market in the US. First of all is agriculturals. As we see here on these 20-year charts, the trend is down for agriculturals and we are at an all-time low, even below the ones of 2002. So this downtrend is going to end sometimes. As we can see here, the momentum is extremely oversold, and it has been oversold for now almost 5 years. The second market which is at key levels is the oil market. And here we've got also something like 30 or 40 years of data from 1984 to 2020 almost. 3 levels that we need to remember. Right now, oil price is about 62, but we need to remember that we are in a triangle delimited by the blue lines here between 77 on the top and 41, 44 on the bottom. You remember that in 1990, the big shock due to the war had a spike at 41. And you recall that in 2018, we never went below 44. So basically, here we are at a decision point. Oil has been rising since December, at the same time as equity have recovered, rising from about 42, 44 into the level of 64. But watch, this is taking the form of a rising wedge. And rising wedge sometimes is a difficult pattern because it can indicate, even though it's rising, that it is close to a top. And if we look closely, you notice that this 64 level has been support in the past during 2018. Therefore, here there is really key levels which has to be overcome in order to indicate a rise to 77, or in case of a failure to rise, it will pull back toward 55 about. So we need to remember 64 on the top, 55 as a pullback, and if it breaks 64, above to 77, but not much more, not 100. Then we have Dr. Copper. Dr. Copper is a so-called leading indicator among technicians because it represents economic growth, if you wish. It was very famous during the growth phase of China because there it was correlating very well with the growth of China. Here what we see since 2011, well, a triangle. That means prices are converging together. And within that triangle, we have rebounded recently from 255 towards 300. This is a monthly chart, of course, a very long-term chart. And we notice that above 300, it could go to 330, but not much more because we see the Bollinger Bands are narrowing. That means the volatility is decreasing. Here we have no signal yet, but most probably an indication that big speculation in the copper market is not yet available. Then we notice that, of course, if materials and copper, which is a little bit outperforming the other metals, is doing and continue to do well and goes above 300, it will have a positive impact on the US sector materials versus the S&P. As we see, that was not the case so far. The orange line has been coming down all the way for now more than 13 months. And just right now, it's testing the blue line and trying to break the downtrend. But it has not done yet. And here we notice also the cloud above it is still capping the resistance. So a lot of work has to be done in the coming 2 or 3 weeks in order to signal something. But as everybody is underweighted this sector, that's something that we need to watch for. Then we have on the commodity side key levels. but we also have a key movement in the interest rate side. Look at the 10 years. 10 years has made a lot of headlines recently in the last months of March by moving from 260 down to 235. That was a surprise because it was below even the low level that we got in December when everybody was scared about the US equity market. Now it's trying to make a V-shaped bottom, but it's still below 250 where there is an important gap. Key levels to remember, 250, if it moves above it, it will go back probably to 280, which is where the cloud is. Then we will see what happens, probably a pullback before any of new direction toward higher rates will come. So we have time there. And of course, if interest rates are rising a little bit, that's good for the financial sector in the US, and that's something that we will watch too. Then, if we have rising rates, we should be a little bit careful about what happened on the US spread between high-yield corporate bonds and investment-grade corporate bonds. Because we know that enterprises have loaded a lot of debt. And therefore, if the spread, you see the black line here, when the black line is going down, that means the spread are widening. When the black line is moving up, that means the spread are narrowing. Now they seem to try to narrow a little bit and go along with the S&P rising. But you see, the S&P is soon close to its previous high, but the spread is much further away from its former high. So here we might have a divergence, and if this divergence is lasting, that means probably that the message from the corporate bonds spreads is going to be more important than the message from the S&P. That means if corporate bonds are not making a new high in the S&P will be at risk. Then we looked at the dollar. And you notice that here the green line on the S&P 500 here is sometimes coming down, like we had a small correction during February or even March. And every time that the S&P is coming down, the US dollar index is moving from the top of its range to the bottom of its range, as if the US dollar was going to save the US equity market. By going lower, it's of course favorable for multinationals and helps the index of the S&P up for the large caps. So here we need to remember we are in a very narrow trading range for now more than 8 months, and trading range don't last forever. Sometimes there is a breakout, and if there is a breakout, we should be very attentive to it and notice if it is a break up or a breakdown. All of that tells us that even though the US dollar seems to be well managed and helps sometimes at the right time the US equity market, the rise that we've got from the low on December 24, around 23.50, towards now 28.70, not far from 29.40, which is the all-time high, is taking not a straight line rise, but it's taking the form of a wedge, as we see here on the blue dotted line. And there is 2 more movements to be done before the wedge eventually breaks and ends. And when a wedge is ending, there is a correction which is usually larger than the previous one we had in the last 2 months. With that, I'll see you in 2 weeks. Thank you for watching.